Welcome to GRE. I'm your host, Keith Weinhold. The president has called the Fed chair a dummy, and worse, how does this all affect the future of mortgage rates? Also, I discuss 30-year versus 15-year loans. Can you bundle multiple properties into one loan? Then how Fannie and Freddie going public could permanently increase mortgage rates. Today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Pawtucket, Rhode Island to Poughkeepsie, New York, and across 188 nations worldwide, I'm your host, Keith Weinhold, and this is Get Rich Education. Not to inflate a sense of self-importance, but each episode is an even bigger deal than a New York Jets preseason football game. You might have thought you knew real estate until you listened to this show. From street speak to geek speak, I use it all to break down how, with investment property, you don't have to live below your means, you can grow your means. As we're discussing the mortgage landscape this week, I recently had a bundle of my own single-family rental homes transfer mortgage servicers from Wells Fargo over to Mr. Cooper. And that was easy. I didn't have to do anything. The automatic payments just automatically transferred over. And yes, Mr. Cooper. It's sort of a funny sounding name that you don't exactly see them putting the naming rights on stadiums out there. But the new servicer prominently wanted to point out the effect of me making extra $100 monthly principal payments and how much in interest that would save me over time, sort of suggesting that it would be a good idea for me to do so. As you know, like I've discussed extensively, extra principal paydown is a really poor use of your capital. It's a lot like how in the past, now you've probably seen it like I have. Your mortgage company promotes you making bi-weekly payments all year, so you'd effectively make some extra principal pay down each year that way. Don't fall for it. Banks promote bi-weekly payments because it sounds borrower-friendly. It encourages an earlier loan payoff. Well, that actually reduces lender risk and increases your risk. And the whole program can come with extra fees, too. It just ties up more of your money in something that's unsafe, illiquid, and with a rate of return that's always zero, since that's exactly what home equity is. As we're about to talk mortgages with an expert today, I will be sure to surface that topic. We'll also talk about the housing market effect of a president firing a Fed chair. When you're living under the rule of a president that desperately and passionately wants lower interest rates, you've got to wonder what would happen if a president just had the power to go lower them himself, which is actually what most any president would want to do. But you almost don't have to wonder what would happen. You can just look at what actually did happen in Turkey. Now, yes, Turkey already did have an inflation problem worse than us, for sure, but Turkish President Erdogan went ahead and lowered Turkey's interest rates despite persistent inflation. I mean, that's a situation where most would raise rates in order to combat inflation. Well, lowering rates like that soon resulted in substantially higher inflation to the tune of almost 60, yes, 60% per year before cooler heads prevailed and the Turkish government was forced to drastically raise rates. But it was too late. The damage was already done to the reputation of Turkey's economy and its everyday citizens and consumers. I mean, that was a painful, real-world example of how critical central bank independence is. You've also got to ask yourself a question here. Do you really want to live in the type of economy where we would need a bunch of rate cuts? Because when rate cuts happen, it usually results from the fact that people are no longer employed, or we're in a recession, or financial markets are really unstable. So there are certainly worse maladies out there than where we are today, which is with moderate inflation, pretty strong employment, and interest rates that are actually a little below historic levels. I mean, that is not so bad. Before we talk both long-term mortgage lessons and more nascent mortgage trends today, coming up on future episodes of the show here, a lot of info and resources to help you build wealth as usual. Also, an A&E television star of a real estate reality show will make his debut here on GRE. Hey, do you like or even live by any of the enduring GRE mantras like don't live below your means, grow your means, or financially free beats debt free, or even don't quit your daydream? Check out our shop. You can own merch with sayings like that on them, or simply with our GRE logo on shirts and hats and mugs. And I don't really make any income from it. The merch is sold at near cost, and it actually took a fair bit of our team's time to put that together for you. So check out the GRE merch. You can find it at shop.getricheducation.com. That's shop.getricheducation.com. Today, we're talking to the longtime president of Ridge Lending Group. They specialize in providing income property loans to real estate investors like you, and she's also a longtime real estate investor herself. I've shared with you before that Ridge is where I get my own loans. They've worked with tens of thousands of real estate investors, not just primary residence owners, but real estate investors, as well as homeowners all over the country. And at this point, she's like a GRE icon, a fixture, regularly with us since 2015. Hey, welcome back to Get Rich Education, the inimitable Caeli Ridge.
Ooh, Mr. Keith Weinhold. Thank you, sir. So good to see you, my friend. Thanks for having me.
Yeah, you're opening up that thesaurus tab right about now, I think. Maybe. Caeli, why don't we have the chat everyone wants to have? Let's discuss interest rates, starting with the vitriol from Trump to Powell has reached new heights this year. Trump has called Powell a numbskull, Mr. Too Late, a real dummy, a complete moron, a fool, and a major loser, among other names. And, at times I've seen realtors even blasting Jerome Powell for not cutting rates. Well, the Fed doesn't directly control mortgage rates, and it's also not the Fed's job to boost realtors' summer sales. It's to protect the long-term stability of the U.S. economy. Tell us your thoughts.
So this is a rather complicated topic, okay? And there's a lot that under the hood that goes into how a long-term mortgage bond interest rate is going to go up or going to go down. As you said, it's not necessarily just the Fed and the Fed fund rate, which, by the way, for those that are not familiar with this, the Fed fund rate is the intra-daily trading rate between banks. So while there is a connection between that and that of the 30-year long-term fixed rate mortgage, they are not the same thing. And in fact, statistically, I believe I read this last week, the last 3 Fed fund rate reductions did the opposite to long-term rates.
Right.
So we went the other direction. So please be clear that the vitriol, as you say, of President Trump and what his opinions are about Mr. Powell and his decisions to keep that Fed fund rate unchanged for the last several meetings that they've had, I think is more of a distraction, but that's another conversation. Overall, I would say that is he too late? Is he right on time? There's so much data and so many data points that they're looking at. And there's this thing in the industry called a lag that in truth, they're not getting the actual data points that they need real time. It's lagging. So the data that's coming out to them today isn't going to be what's relevant and necessary to make changes tomorrow, next month, and next week. Most recently, you probably saw in the news, the BLS, Bureau of Labor and Statistics, and the jobs report came in far under what the expectation was. So that might have been the catalyst, I think, that will drive Powell and group to reduce. That is the overwhelming expectation that the Fed fund rate is going to come down. By how much? We don't know. Secondary markets are already baking that in, by the way. So when we talk about long-term interest rates, I'm starting to see some changes on the day-to-day. I get access to that stuff, and I'm looking at it daily, the ticker tape of where the treasury bonds and things are. So I'm starting to see some slight improvement to interest rates in preparation of that market expectation. Interest rate on the Fed fund level will probably reduce. But I think overall, Keith, that the Fed is in a really difficult position, because when you think about what really is going to drive the Fed fund rate and then potentially the long-term rate, is counterintuitive to what most people or consumers expect, right? They think if the Fed fund rate reduces by 1/4 percentage point, then a long-term 30-year fix should probably reduce by the same amount. It does not go hand in hand like that. Now, while there are trends, right, that doesn't happen that way. And more often than not, the worse our economy is doing, the better a 30-year interest rate will be. So in my industry, I'm kind of always playing on the fence thinking, I don't want anything bad for our country and the economy. However, the worse it does, the better interest rates are going to become. And if you've been paying attention, the economy is in decent shape. We're not doing that bad. Inflation is still up. So the metrics that they're using to kind of gauge and predict that lag and where we're going to be are not in line to say that interest rates are going to drop 1/2 or a point or a point and a half in the next year to 18 months. Those signs are not out there for me. All of that said, I know that interest rate is top of mind I'm on the phone all day long. I like that part of my job where I'm still interfacing with investors on day to day. A big chunk of my day is spent talking to clients. And that is one of the top questions, probably one of the first questions that come out of their mouth. Where are interest rates? What are interest rates? And what I have sort of started to really form and say to that question is, if interest rates are the catalyst to your success in real estate, you probably need to do a little bit more research, because interest rates should not be the make or break for your success as a real estate investor.
The Fed has a dual mandate of maximum employment and stable prices. Inflation, though still somewhat elevated, has stayed about the same the past few months. History shows us that the Fed is more comfortable with inflation floating up than they are with suppressed employment levels. To your point about recent reports about us not adding many jobs and the Fed being concerned about that, the translation for those that don't know is if the job market is weak, lowering rates, which is what increasingly people think they tend to do later this year, lowering rates helps encourage businesses. It's more likely that businesses will borrow and expand and hire more people, therefore, if rates are low. Now, whether that translates into a lower mortgage rate or not by lowering that Fed funds rate, yes, there is that positive correlation. Generally, the lower the Fed funds rate goes, the lower mortgage rates tend to go, although that isn't always the case. To your point, Caeli, late last year, there were 3 Fed funds rate cuts, and mortgage rates actually went up, which is somewhat of an aberration. That usually doesn't happen that way. But that's the environment we're in. Most people think Fed rate cuts are coming later this year.
Yeah. And I would say, the other thing too, when we talk about the pressure that the Fed is under right now, specifically Powell, he's being attacked, fine. And whether I agree or disagree, really important for listeners to understand that the indifference that the Fed is supposed to have, right? Bipartisan, it's not supposed to have a dog in that fight. If it did, the calamity, I think what would happen economically in this country would be devastating if other economic powers were to see that our particular financial institutions are swayed one way or another politically. That would be devastating to us. So I think Powell has done a decent job at staying the course. He's continued to do what he says what he does. So far, I'm okay. Is he late to reduce rates? I don't know that I'm qualified to say that. Maybe, but at the same time, I think that his impartiality has been consistent, and that for that part of it, I'm grateful.
For those who don't understand, if Trump just told Powell what to do and Powell followed Trump's orders, how does that devastate the economy?
It shows partiality to or fealty to one particular party, right? It's not an independent institution where financial policy, quantitative easing, quantitative tightening, all of those different things that are necessary to keep the pistons pumping, it isn't. It's very specific to Fieldy and the leader of telling based on potentially ego or other elements that have not a lot to do with fiduciary responsibility.
If Powell did everything Trump said, I feel like we would have negative interest rates right now.
That could be a problem, especially if the economy and inflation is on the rise. And then you get the tariffs. I mean, there's so much layering to this. I mean, we could go on and on about it. But overall, let me close with this. I think that interest rates are probably on the run, if I had to guess. Now, there's all kinds of variables that could make that statement untrue. But overall, in the next year to 2 years, I do think we'll see some relief in interest rates, barring any major catastrophe. But again, investors, if your success, if you're tying your real estate portfolio, your real estate investing, whatever modality you're interested in, if you're tying that to an interest rate and there's a certain number that you have ethereal in your mind, you're going to lose. Your success in real estate, interest rate is a component of it, but it should not be tied to your success or failure. You should be able to do the math and look at the differences in real estate opportunities, investment, whether it be long-term, short-term, mid-term, single family, 2 to 4, appreciation, cash flow, all of those things should be considered, and you will find adequate returns independent of an interest rate if you're diversifying that way.
There is more evidence that Americans have warmed up and gotten somewhat used to normal mortgage rates, this normalization of mortgage rates. They are pretty close to their historic norms. In fact, a recent housing sentiment survey done by Turbo Home found that in Q1 of this year, 41% of homeowners surveyed said that a 6% mortgage rate was the highest they would accept on their next purchase. Right? That was back in Q1. Today, up from 41%, 52% of respondents now say a 6% mortgage rate is the highest that they would accept. Evidence that people are warming up and normalizing this.
The other thing, too, is the pandemic rates, right? That's been a very hard shell to crack. The people that got these 2 and 3% interest rates during 2020, 2021, part of 22, they're really reticent to let those go. And I think that they're doing themselves a disservice as a result. If you can get a second lien HELOC, okay, fine. But overall, if you're just going to let that untapped equity sit, it's going to be to your disadvantage if you have any desire to increase your portfolio and your long-term financial stability and wealth.
You're listening to Get Rich Education. Our guest is Ridge Lending Group President Caeli Ridge. Much more when we come back, including 30-year versus 15-year loans, which one is better, and more things that the administration is doing to shake up the mortgage market. I'm your host, Keith Weinhold. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Caeli Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K, and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is Rick Sharga, housing market intelligence analyst. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. We're talking with a familiar guest this week. That's Ridge Lending Group President Caeli Ridge. Wealth is built through compound leverage, faster than compound interest, and leverage means using loans. I think most everyone, the first time in their life, they look at loan amortization tables and learn things like, oh, with a 15-year loan, you pay substantially less interest, perhaps hundreds of thousands of dollars less interest with a 15-year loan and its lower mortgage rate than you do with a 30-year loan and its higher mortgage rate. But a lot of people don't take that next step and looked at, oh, rather than paying down my home loan with extra principal payments, if I just invested the difference, I would be substantially better off down the road. So in a lot of cases, the more sophisticated investor chooses that longer loan duration, the 30-year. That's the way I see it. What do you see most of your prefer there?
It's one of my favorite topics to cover because there's quite a few layers that I think can all connect. If an individual wants to pay less in interest, very easily, I'm going to strenuously advise them to take a 30-year over a 15-year and just simply apply the difference. So let's just start with the applicable version of 15 versus 30 and how it can benefit or harm, because this is what a lot of times people that go for the 15-year and wanting to pay less in interest don't understand, and it's never been delivered to them in a reasonable way, I guess. So just looking at those two, and then we'll get to the strategy of potentially reinvesting those dollars elsewhere. But just look at a 30-year and a 15-year. I am a massive deterrent against a shorter-term amortization. I hate a shorter-term amortization because all that's going to do to the individual is limit their ability to qualify later on down the road. And the reason for that is that the shorter term, as you had described, is going to yield a higher monthly payment. So when we pull credit for an individual, that's a higher monthly payment that the debt to income ratio has to support.
Right.
When in fact, if we simply just look at the two side by side, 15-year and a 30-year, equal loan sizes, the 15-year is going to have a lower interest rate, it's true, but the amortization is obviously half the amount. We've gone from 360 months, 30 years, to 180 months, 15 years. So the payment obviously is going to be much, much higher. If you take the payment difference between those two mortgage products and apply it with a 30-year fixed payment, let's just call it $500 a month, whatever the number is, and you are disciplined to send that extra $500 every single month with your 30-year fixed mortgage payment, you will cross the finish line in 15.4 years, I think is the average when you run the amortization. So you'll pay a few extra months worth of interest, but whatever. You'll never pay the higher interest that the 30-year has locked at because you've accelerated the payoff of the debt so quickly, and you've maximized your debt to income ratio and future qualifications. Never take the shorter term amortization. It is to your greatest disadvantage. I hate them. That's part one. Did you have a comment? I can see that your wheels are spinning.
That is a great answer. If you get the 30-year loan instead of the 15, if you apply an extra principal payment, whatever it would be, call it $500 plus, that you will kill off that loan, that 30-year loan, in something like 15.4 years. Yes, and you'll have the lower payment amount for your qualification going forward. You'll have more flexibility in your life. That's great. I didn't realize the difference, 15.4 versus 15, was that small. That's a great takeaway.
Yeah, absolutely. And the other piece, you kind of just hit on it. The individual's feet are not held to the fire at that higher payment. So let's say it's a rental. Okay, whatever. It goes vacant for a month or a couple of months, God forbid, or whatever may be happening. You now get to choose. You are not obligated at that higher monthly payment. You can say, okay, this month I'm not going to pay the extra. I don't, It's all within your control. So you're killing like 4 birds with one stone. I really prefer the 30-year amortization for all those reasons. So now let's take it and move into how I believe, and I agree with your philosophy, taking those dollars and applying them. Because when we talk about mortgage interest, especially on investment property, okay, it's probably a slightly different conversation when we're talking about somebody's primary residence home. But for an investment property, to take that difference and apply it toward another investment, because the interest, remember you guys, we're investors. We want that Schedule E deduction, that interest deduction. As money goes, a 30-year fixed mortgage, even today, as interest rates are elevated beyond the 2 and 3% that people somehow fixated on, that's where interest rates should just be forever. You've got massive amounts of interest deduction, so you're paying less in taxes for that reason. There's so many reasons to stretch out that mortgage on an investment property versus extinguishing that debt. Not to mention, you want to constantly be harvesting equity, ideally, pulling cash out. Borrowed funds are non-taxable, deploying them, but then taking that extra cash flow and stockpiling it for another investment, whether that just be the down payment or for other things. I just think there's so many better places that those funds can go to produce more wealth than accelerating the payoff of that debt that's benefiting you from a tax perspective and several other ways. There's lots of other ways to apply that money.
I often ask, why accelerate the payoff on a, say, 7% mortgage interest rate loan when instead you can take those savings, reinvest them into other real estate where it sounds preposterous on its face to think of the rate of return that you can get from an income property. But when you add up all the 5 ways you're paid, appreciation, cash flow, loan pay down made by the tenant, tax benefits, and the inflation profiting benefit on the long-term fixed interest rate debt, a return of 20% plus is not out of the question at all. So if it's 20, why would you pay off extra on a 7? That's 13 points of arbitrage that you could gain there by not aggressively paying down a property and instead making a down payment on another income property. Caeli, when it comes to these type of questions and accelerating a payoff, why do banks seem to encourage that you make bi-weekly payments rather than monthly payments, therefore accelerating your principal pay down?
I'm not sure the reason behind that. I don't know that I've even seen a lot of that from my lens and my perspective. It's definitely not something I ever comment or preach on. But the overall, what's happening there when you do it, the bi-weekly. So instead of making $1,000 at the first of the month, you make 500 and then 500, right? Middle of the month, first of the month. What's happening there is because of the way the annual calendar goes, it ends up being an extra payment per year. Right? I think that's the math, is when you do it that way, you end up making an extra payment per year. So you can accelerate, and you're not doing anything different necessarily in your cash flow, et cetera. So I don't think there's anything wrong with it. I don't know what the benefit is to the institution that would communicate that to its consumer.
Yeah, it ends up being 26 bi-weekly payments,
Right.
which has the effect of making 13 monthly payments in a 12-month year, accelerating your pay down. In my experience, it seems that banks encourage this. They contact borrowers. They've contacted me in the past, laying out a welcome mat. Hey, would you like this plan here? And in my mind, accelerating the payoff, we already talked about how that's typically not a good investment. The more you know about the trade-off between loans and equity, really, I'm transferring more of the risk onto myself and less there onto the bank when I accelerate my payoff. So
I agree.
I'm not interested in doing that at all.
Maybe, Keith, it could be, because I people talk about this a lot. Those people, and let's say that there are a group of individuals that might benefit. Let's say they're in phase 3, right? They're well into retirement. They just want to start paying off. They're not maybe investing anymore. They just want to leave that legacy, perhaps, or whatever their circumstances are. And they don't want to take additional capital and apply it to the principal and lock up those funds and make them illiquid. So maybe just as an easy sidebar, they just make 2 payments a month versus 1. I get a lot of people asking that question. I mean, over the years, I know that like at the closing table, we'll have clients say, hey, is the servicer going to be set up to accept biweekly payments? And a lot of times they don't. Like SLS, I mean, there's a lot of servicers out there that will not accept or don't have the infrastructure to collect those biweekly. So maybe just as a consumer desire out there, the servicers have gotten wise to it and they just offer it. I can't think of the reason behind why they would promote that to their database. I don't know.
Well, another question that I hear quite often, and probably do as well there, is about bundling multiple properties into one loan. Can you tell us about that?
Yeah, that's called cross-collateralization. So we're taking residential property, okay, and putting them into a commercial blanket loan. So any combination of single family up to 4 unit, 5-plex and above is now considered commercial. So it's got to be single family, condo, duplex, triplex, 4-plex, right? It's residential property. And they're taking any combination of that and putting it into one blanket loan, cross-collateralizing it. Now, I believe the most incentivized way or desire to want to do this is probably for 2 reasons. One, to free up golden tickets, right? Golden tickets are those Fannie Freddie loans that we talk about a lot. There are 10 of these per qualified individual. If someone has maxed out their golden tickets, let's say they've got 12, 13, 14 properties, they could take 5 or 10 or 13, whatever the number, and put them into a commercial blanket cross-collateralized loan. As long as it's non-recourse, that means no personal guarantee is attached to it. The rule per golden ticket will free up all those spaces. So usually this applies to an individual that has a portfolio that has stabilized. This will usually work when the portfolio has had a couple of years to make sure that you've got your consistent tenants and anything that may come up, repairs, maintenance, etc. Stabilize portfolios and then putting them into that cross-collateralization, because the terms are not going to be the same as just a 30-year fixed, okay? Especially if you're going to be looking to take cash out and harvest equity that way. That may be a real opportune time to borrow funds. Borrowed funds are non-taxable. Once again, pull the cash out, put it into a non-recourse loan. You've got $500,000 of capital now that you can then go and get a whole new set of golden tickets for expanding your portfolio. So that's something that we focus on for individuals that have maybe maxed out of that conventional landscape and or are looking to scale and acquire more properties, but they don't want to necessarily look at some of the DSCR loans. They want to get back into the Fannie Freddie box.
Yeah, so someone could bundle and get cash out simultaneously, potentially. Is there anything else that qualifies or disqualifies one for bundling many loans into one like this?
It's a commercial underwrite, so they should be aware of that. Now, certainly we're looking at the individual. Typically, in those loans, the underwriting of those loans, the individual's liquidity and credit are most what we're focusing on, but it's about the property and the portfolio. DSCR, that debt service coverage ratio, is a big factor. So we're looking at the income against the monthly expense. Generally, that's going to be the principal, interest, tax, and insurance. On a commercial basis, they throw in the maintenance, vacancy, etc., averages. So you want to see, generally speaking, about 1.2 on those when you divide the incomes and the expenses. And then otherwise, yeah, LTV might be a little bit restricted on something like that, 70% usually. Maybe you can get as much as 75 if you've got a really strong portfolio. But otherwise, for you individually, liquidity, some liquidity there, and good credit is what is important. As long as the portfolio is operating at a gain, then you're good to go.
Yeah, that cross-collateralization could be really attractive. Well, Caeli, we've been in this presidential administration that has shaken things up like few, if any, prior administrations have. One of those things is that they have pushed for cryptocurrency holdings to be recognized as assets in mortgage loan qualification. Now, that's something that would probably pend approval by the FHFA, and critics cite volatility. I mean, there's been a pattern where every few years, Bitcoin drops 80% before rebounding, and I'm not exaggerating, and that has happened a number of times. And another administration desire is this potential Fannie Mae Freddie Mac merger or an IPO, an initial public offering. Can you tell us what that's about?
Let's start with the crypto first. Whether or not this gets through the Congress and or FHFA, however that develops and becomes actualized, that may be different than what the lending institutions decide to take a risk on, right? The allowance of that crypto. So even if it's approved and they say that, yes, that we can use this for asset depletion or reserve requirements or whatever it may be, I don't know necessarily that you're going to see a lot of the lending institutions jump on board. I think they'll probably have overlays. It's just kind of the layering of risk on the crypto side to ensure that the asset and the underwrite is less likely to default. I don't see a lot of lending institutions that are probably going to jump on that bandwagon immediately. That's probably going to need more time and consistency with that particular asset class. That's the crypto thing. So that's a TBD. On the other side, we're talking about conservatorship. So post 0809, right, the housing crash and Dodd-Frank. If you've not heard of those names before, they're just the last names of individuals that rewrote that sweeping legislation across all sectors of finance once we saw housing and lending implode upon each other. Fannie Freddie, as a result, went into conservatorship. Now, what they're saying, what the administration is saying is that they are going to say that the implicit guarantee, actually, let me back up really, really quickly. I will not take too much time on this. So Fannie Mae and Freddie Mac, the reason that those products are the golden tickets, as we call them, and we're just focused on investor products right now, is because highest leverage, lowest interest rate. And why is it like that? That's because it has a United States government guarantee against default. So this mortgage-backed security is bundled up with other mortgage-backed securities and sold, bought and sold on the secondary market to investors, foreign and domestic, right? Investors that are buying mortgage-backed securities, they know that that paper is secure. If it defaults, we've got the United States government that's giving us a guarantee against default. So that's why it's such a secure investment. If we come out of conservatorship, technically that would normally mean that you may not have that implicit guarantee. However, the Trump administration and those that are in that space, FHFA, Pulte, and all those guys, they're saying that that guarantee should still apply. If that happens, if that's how they release this, I don't see anything wrong if they do it without all of the volatility. Let's use the tariffs as an example. It was all over the place. It was there and then it was gone. It was up and then it was down. It was 30% and then it was 2%, right? It was just so much, and the markets really had a hard time with it. And as a result, I think a lot of people lost massive amounts of wealth in the stock market because of that. So I think that there is some real benefits to getting the Fannie Freddie, the GSEs, government-sponsored enterprises, out of conservatorship. I think it just opens up for more fair trade in the market, but they have to do it the right way. And as long as they keep that guarantee, that government guarantee, and then they take their time and apply the steps appropriately, I think it could be a good thing ultimately for the consumer. Now, if they don't, it could really have devastating impacts, and I think it could even raise interest rates higher. I know Trump and folks don't want that, so I think they're mindful of it. That's just kind of the take I get, but we'll see.
Yeah, because that's my preeminent thought with this, Caeli. If Fannie and Freddie come out of conservatorship and there's no government backstop on those loans, it seems like the banks are exposed to more risk and consequently would have to compensate for that potentially with a higher interest rate.
You said it better than I did. Yes, I get too technical when I go down those rabbit holes. That's exactly right. I do not think that they will go down that path without that implicit guarantee. I expect if this thing comes to fruition, I expect that guarantee will be there.
Yeah, it does seem likely with as much administration concern as there is about the housing market and the level of mortgage rates and all kinds of interest rates out there. Well, Caeli, this has been a great wide-ranging conversation all the way from strategy to what the administration is doing in interfacing with the mortgage market. If someone wants to learn more about you and your products, tell us what you offer, including your very popular all-in-one loan there at Ridge.
Ooh, thank you for teeing that up. Yeah, especially right now when people have a lot of concern about interest rates, right or wrong, the all-in-one is a very unique product that removes that fear. It's a way that investors especially can take control of their equity, pay less in interest, and sometimes hundreds of thousands of dollars less in interest while maintaining equity and flexibility and liquidity. Cannot say enough about this product. The all-in-one first lien HELOC is my very favorite for the right individuals. We've talked about it many, many times. They can find us talking about it all over YouTube. You and I have quite a few conversations about that. So that and so much more, guys. So the all-in-one, you've got the Fannie Freddies, our debt service ratio products, our bank statement loans, our asset depletion loans, ground up construction, bridge loans for fix and flip or fix and hold. We really run the gamut there in terms of loan product diversity. There's very little we can't do for real estate investors. So we're uniquely qualified in that space.
And you offer loans in nearly all 50 states now. Tell us more and how one can get a hold of your company.
Yes, we are licensed in 49 states. The only state we're not licensed in residentially is New York. We can still do commercial there. But to reach us, you can find us on the web, ridgelendinggroup.com. You can email us info@ridgelendinggroup.com, and feel free to call us at 855-74-RIDGE, 855-747-4343.
I'm so familiar with all those avenues because, again, that's where I get my own loans myself. Caeli Ridge, it's been valuable. As always, thanks so much for coming back onto the show.
Thanks, Keith.
A lot of experts believe that stripping Fannie and Freddie's public backing and taking them public, that will increase mortgage rates. See, besides there being more risk, like we touched on there during the interview, Fannie and Freddie would face strong incentives to increase profitability, to make an IPO appealing to potential investors. That's just another reason that would probably increase mortgage rates. But if you're the type that truly champions free marketeerism, then the government would get out of Fannie and Freddie and let them IPO, and you would want to see that happen. Now, you, as an investor, you probably resonate with the fact that rather than having to methodically and even painfully save money for your next property, instead, you can just borrow funds tax-free out of your existing property, and that way you're using more of other people's money, the bank's money in this case, and less of your own. Similarly, if you avoid aggressive principal paydown, well, you would just retain those funds in the first place. As you can see, Caeli is really good at taking a deep look at what you've got to work with and helping you lay out a strategy that might make sense, keeping in mind and evaluating your cash flow, equity, DTI, and loan-to-value ratios. They offer free 30-minute strategy sessions. You can book one right there on their homepage at ridgelendinggroup.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
You know, whenever you want the best written real estate and finance info, oh, geez, today's experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.